to the long side. And what I want to do tonight is give you as much detail as I can on the trade. So we need to do the disclaimer here, of course. You can read that at your leisure. If you have any questions about the trade setup at all, just go right ahead and ask, and we'll do a little break at that point and try to answer your question. Or if I don't get to it right away, I'll just note it here, and that means that I'm going to cover that question in a little bit later in the webinar. So what are we going to cover tonight? We're going to talk about the key elements of a spring. I'm going to go right from ground zero and bring you right up to 60 miles an hour in a few seconds. So we're going to talk about the key elements of the spring. I'm going to draw it out for you on a conceptual map of the spring. Okay, sorry about that. All right, so we're going to go through the key elements of the spring. I'm going to draw you a conceptual map of the spring so you have a good sense of what it looks like conceptually. Then we're going to talk about actually the classic elements of the spring, and then we're going to go even beyond the classic Wyckoff spring and talk about the background conditions to look for. We're also going to review the 3 times that I'm familiar with when springs fail and why that happens, so that you've got a good sense of that. This is a trade setup. It's got a good probabilities. They don't always work, but it's pretty high odds. I mean, I probably get, when I look at my own personal statistics on these trades, anywhere between 75 to 80% win rate on the trade. And one of the nice things about it is that you can assess your danger point and locate your stop at a pretty close, pretty tight level. And the win to risk or risk to reward ratio on this is pretty good as well. I'll talk about some key entry considerations tonight, a couple of different ways to enter the spring, where to exit, and give you some options on that as well. And then we're going to go into the actual trade setup specifications. I'll detail those out for you. And then we're going to talk about a bunch of examples. And in those examples, I'm going to talk about some of the nuances of the spring, some of the things to watch out for, other ways to combine them with, to make them even, with other elements of the market to make them even stronger, even higher odds trades than just blindly going in on them. The idea here is to go deep into this trade setup. We're just going to focus on springs, one thing, one trade, and one trade only. Okay? All right. All right. So, anybody have any questions here or any comments before we start? Before we get into the key elements, let me just give you a little bit of background here. This is a Wyckoff trade. It actually, though, it wasn't developed by Richard Wyckoff. It was developed later by a fellow whose name is Robert G. Evans, Bob Evans. I never met either. Both have passed away long before I got into trading. Wyckoff, as you all probably know, was a broker and a trader in the early part of the centuries. He died in, I forget if it was 32 or 34, 1932 or 34. But he did set up a educational institution, if you will, to carry on his work, to preserve his work and to carry it on. He wanted the public to understand how to trade and how to trade by reading the market's own actions. And Bob Evans, became owner of the Wyckoff Associates, later to become known as the Stock Market Institute. And he had ownership and was the main person to educate folks through the 50s and 60s anyway, and probably into the 70s, before he turned it over to Dave Matthews and other folks. During that time, Bob Evans wrote what became known as Unit 3, which is sort of like the New Testament versus the Old Testament of the Wyckoff course. Wyckoff's original course is now called Unit 2, and that's considered to be the Old Testament. And then Unit 3 was what Evans contributed to largely what he contributed to the Wyckoff course, and that became known as Unit 3. And in that is the spring. Bob Evans noticed that price would often dip under support and then spring higher up on a rapid rally, and he called it the spring. So the key idea here is just that. We see a level of support that gets established, and it rallies off of that support, and then price returns to that support level and dips down below it. But lower prices are rejected, and then the market rallies back up, closes above that support, and typically, in typical spring fashion, it will pop up high and do a rapid rally up to higher prices. So in the classic Wyckoff or Wyckoff type spring, what Evans would look carefully at was the supply that existed as price came down below that support level. And he did that in a number of ways. He looked at it in terms of the spread or the range of the bar as it dipped underneath. And the range, of course, is nothing more than just the difference between the high and the low of the price bar. And the smaller the range, or the smaller the spread, and range and spread are synonymous, the less supply, the less activity was occurring down below that level of support. The close was also important. Closing above support is a pretty critical element of a spring, and closing on the high of the spring bar itself shows us that buyers are in control. And then the amount of volume. In the classic spring, the lower the volume on the spring, the better. Less volume means less supply. But I'll show you that that is not necessarily true. I'll show you that high volume on springs are often very good trades in the right context or circumstances. Okay? So let's take a look at a conceptual map of the spring. And as I suggested, price establishes a support level here at A, rallies up, and then spends some time up here, comes back down, dips under that support level at B, but then turns right around rapidly, usually within a few bars, often on the same bar, or you'll see one bar come down and next bar right back up. Sometimes it's a few bars. And then closes above that support line, drawn off of the lows at A, and then continues on up higher. Now, sometimes we'll see the market rally up and then come back in and test here. It's a variation on the spring. Test in here before rallying up higher, or often we'll see it just go. Probably, well, I don't know, maybe 35 to 40% of all springs will test. Maybe a little bit higher than that. Maybe it's more like half of all springs will test, and the rest will rally right up from there. And that's going to be a choice point for you. So let me just make a comment to Song here. So this is the conceptual map. We come down, we establish support at A, we rally up, we come back down to that support, dip underneath of it, and that's represented here at B, and then we rally up. And we will sometimes see the market test that support level before rallying up higher. But the key point here is that lower prices at this point at B are rejected. Supply doesn't come out. In effect, it's like there's a challenge being issued, so to speak, to sellers by dipping down. It will draw out breakout traders that are looking to short the market as the market's coming down, and it's often called in some circles a bear trap, where the sellers do get trapped on the wrong side of the market. They go short as price dips down, but then it rapidly turns against them, and that actually fuels they're having to cover their shorts, and they're buying back their contracts that they sold or their stock that they sold down below, and that fuels the rally going up. All right. In the classic spring that Evans originally described back in the 1950s, he found that springs occur typically late in the trading range. There would be a large amount of accumulation that occurs, and either there would be a shakeout or a spring. Spring being a milder form of a shakeout in that particular instance. Okay, and the spring would mark the end of the accumulation period. We would then expect from there a good, strong sign of strength, meaning a rapid rally up and breaking through what became known as the creek, or breaking through the resistance level that kept prices in a long trading range. When the spring was originally classified as a trading technique, it was understood that stronger market participants, the composite operator or the smart money or the professional traders, the larger operators in the market who are buying, who bought throughout all of the accumulation range, they were making a definitive assessment of supply before rallying the market up. Now the reason for that is because they didn't want to be buying at higher prices any supply that existed. So they would dip the market down lower and look for supply to come out in the market. If there was supply, then they would have to deal with it at that point. Better to deal with it at lower prices and acquire that supply than have to buy into it as the market's rallying. So the stronger operators in the market would be assessing supply before rallying the market, and that was the main purpose for the spring. Okay. It also, because it does draw out some supply, some sellers, it allows for the stronger participant to gather additional stock from weaker folks at lower prices. When we talk about strong participants, we're talking about the institutional traders, the professional, the large operators like the George Soroses and the Warren Buffetts and the Goldman Sachses, I suppose, of the world, right? And other big traders, people who have large capital, really understand their market, and can sustain little shakeouts without being fazed by it. Weaker participants are folks like maybe you and I, where our account sizes are much smaller than the larger folks, where our understanding of the market may not be as good as theirs, certainly the fundamentals of the market that they're trading, and we can't sustain a shakeout, a dip down in price if we're long, and we're apt to throw that stock back out to them. So it's a way for the stronger participant to also acquire additional stock. Okay. So here's a good question. Tyrone asks, is a spring with a higher range, a longer range, I assume you mean, a lower quality than springs with shorter range? No, not really. We'll talk about that, and I'll show you numerous examples tonight about that, and show you that that's not really a material consideration. Here's a good example of a classic spring, the classic Wyckoff spring. We've had some kind of a down move here. It was too large of a chart to put on. Actually, I ran out of data, I think. This goes back to 2001. And we have some climactic action occurring here with high volume. Some more stopping volume comes in here. We're in a trading range that goes for a full over a year and several months here. And it comes down, dips down below here, and springs this level. We see a sign of strength come up, a little testing occurs, and then the market takes off and goes up. In fact, this is a tenfold increase, more than 11-fold increase in this stock before we see some climactic action up here. So this is kind of a classic type of spring, where we see a long drawn-out trading range occur that gives larger operators the ability to acquire stock at low prices. This is accumulation in here, and it's the end of the accumulation is marked by a spring. And that's classic. Okay. Here's another classic example, maybe a little variation on the classic example, and this occurred more recently here's our 2008 down move. We get climactic action in here, testing goes on, a trading range forms along in this area here. This is the so-called creek or supply level, where supply comes in each of these rallies up. And now in this instance, we're holding a higher on this stock, and this is EWZ. It's one of the stocks I really like to trade. It's the ETF for Brazil, the Brazil Country Fund, and it's pretty volatile, and it can move pretty nicely, as you see here. Here, we start to hold our lows at a higher level than the climactic and testing action that occurred down lower. And at A here, we spring this trading range, this kind of secondary trading range that's formed in here. And you can see that there's a small testing that's occurred in here just after the spring is sprung, so to speak. And then we see a nice sign of strength that breaks up above or comes up to the supply level. It gets tested, and we go higher and higher and higher, and are still going higher, in fact. Okay. So two nice examples of the classic spring. Any questions on that? And I'm going to be more I see a lot of familiar names here, and it'll be a little bit more in a presentational mode tonight rather than question and answer kind of thing. But did anybody have any questions about what we've covered so far? Is this reasonably clear to everybody? So that's the classic spring. And that continues to occur, as you see here. And we look for these to occur as a mark to the end of a classic accumulation level after we see a strong bearish market climax, culminate, and then go into that trading range. And again, you can see that we saw climactic action beginning here sometime in early October, and it wasn't until March of the following year that we start to rally. We start to complete that accumulation zone and start to rally up. Okay. Why wasn't October a spring? Good question. In effect, it actually was a spring, but it was probably a little bit early in this trading range. I mean, you could have taken it as a spring and traded it that way, but once you got into this area in here, you would realize that we're still not done with this accumulation at this point. Okay. All right, so that's classic spring. A couple of examples there with a variation of higher supports. What Wyckoff called supports, we would call lows today. All right. Here's another classic example on a weekly chart. And this is very nicely classic because this is as I say, on a weekly chart of a stock where we see some climactic action occur, the so-called automatic rally, the rally that comes up, and this is a nice rally because not only do we get this lovely little climactic bar closing on its high, but the next one closes almost on its high and goes deep into the supply area over in here, indicating that buyers were coming in force and were not being deterred by the supply. We come down and notice that this down move, compare this down move with this one that fell out of bed on us, right? This is just, you know, what I would call lackluster or a very weak reaction, a weak down move. Here we had wide ranges, closing on the low, volume coming in. Here, volume is, you know, volume comes in, but it's coming in more on an up bar here. We get a little volume over here, but it immediately rallies after that. And in a classic spring fashion, we come down to B, break below the support level for a week here, and then turn around and rally back up. We also have a nice bottom reversal occurring as well, for those of you who understand what that is. And volume comes in to the upside after that. It's a beautiful spring here, and you can see that this doubled this more than doubled this stock price. Okay. So one of the things to begin to understand about springs is that they happen on all time frames. The classic springs would be described on a daily chart because back in the 1950s and 60s, before the advent of computers and computer charting, everything was done by hand, and they really didn't do, they did do intraday trading, and they did, they used a form of, in the Wyckoff school, they used a form of a figure chart with volume before the ticker got to be too rapid and everything became electronic. But when the tape was still fairly slow and people could make notations by hand, they would use that. That was more convenient for them than drawing bar charts by hand every 10 or 15 minutes. Today, of course, everything is sped up quite a bit. The data comes flowing through our computers, and so it's much easier for us to use bar charts. And I'll show you that not only is it on the daily and the weekly charts, but on the 5-minute chart, the intraday chart, that we will see springs occur, and with regularity as well. Okay, just a little bit more on the classic spring here. Again, the idea is that supply has been exhausted, particularly when the volume is light on the retest of that support level. One of the key things about the spring, classic or otherwise, is that the danger point is identified. What do I mean by the danger point? Well, what I mean is that the low, let's go back up to a chart and make it easier for me to describe this. When we're looking at the penetration of the support at A, and then it turns around for us on B, then we know that the danger point is right here. We do not expect this market to fall back down and come back below, just under the low of the spring bar at B here. So we can now set a reasonably good and a reasonably safe stop. This is our danger point, and we want to see the market rally away from the danger point. And in this chart, as we often will see in a spring, it rallies with a lot of vigor, okay? And we can quickly move our stop up if we want to do that once it rallies away like this. But the danger point is defined for us, and then we can set our risk parameters, we can set our stop, assess our risk, and that's a very nice feature of this particular trade. And then also, when volume is moderate on the spring, we can, according to the classic view of the spring, we would expect it to be tested. In fact, the Wyckoff SMI folks, Bob Evans, had 3 different categories of springs. A number 3 spring, which was very light in volume and relatively narrow in spread or range on the spring bar as it dipped down and then turned around and closed back. So There, Bob Evans advised, go right ahead and take that spring and take the trade right on the spring bar. A number 2 spring in the classic Wyckoff spring model was moderate volume on the spring and wider spread or wider range. Still springs down, drops down below and closes back up above support, still has the key features, but the volume is a little bit high, suggesting that there was some supply there. And Evans recommended that the spring then be tested before an entry is made. And you certainly can do that. And we'll talk about entries in a moment. And then a number 1 spring, and I'm not sure why he classified it this way. I think he really just loves springs, but the market looks like it might try to hold, but it really doesn't, and it continues to go lower. So it's a penetration down through support, and it continues to sink lower. Okay. Song has a question. Does the reversal bar of the spring have to be the next bar? No, not necessarily. I like to see it within a few bars. Usually when there's more than just a couple of bars, when there's more than just 2 or 3 bars, it's typically a spring on a higher time frame. If we go back to this spring here on this weekly chart, well, there would be at least 5 days down below. If we were looking at this on a daily chart, there would be at least 5 days below the bar, below the support level on the bar before B, represented here on the weekly chart. And then there's likely to be more than 5 days. Maybe there's 7 or 8 days down below here. Okay, so when there's more bars than, say, just 2 or 3 down below, it's probably a spring on the next higher time frame, and you'd want to look at that to you'd want to look at it anyway, but you'd want to look at the, if you're looking at it on a weekly basis, you'd certainly want to look at a daily to see what that looks like there. Okay. After the 2-bar reversal, does the next bar, there's a question from Aaron, after the 2-bar reversal, does the next bar have to be up to confirm the strength seen? That's a good question. And the answer is it's better if it is, but it doesn't have to be. If we were looking at this, and if we were looking at this and the next bar came down and held that spring or held right around it or maybe dipped down again and closed above it, that would be perfectly acceptable to me. And I'll show you some examples of that tonight too. Raja asks a question, what do I mean by supply exhausted? Is it volume? Yes, it means volume. The spread is also important too. Notice, Raja and everybody else, that look at the bar before B here, this bar, look at how narrow the spread is. And the volume, of course, is low down here. Now, the spread or the range of the bar indicates activity, right? Compare this bar here, I'll call it bar number 1. Compare bar number 1 with this bar up here, which I'll call number 2. Look at the spread on bar number 2, okay? What this signifies, and by the way, this is the volume, I think, for this bar. What this signifies is lots of activity. A lot of buyers are coming in here. Some selling, certainly, because you wouldn't have all this volume. But the buyers are just eating through that selling, and there's enormous amount of activity on bar number 2 compared to bar number 1. So thinking about this logically, as we come down on bar number 1, and spend a week down below A, and there's hardly any progress to the downside, we can say that and we see that the spread here is narrow, we can be looking for a spring. We can say, gee, I wonder if that's going to spring up. I'm going to put this on my watch list and take a good, careful look at it as the week progresses here. Why? Because the supply is exhausted. There's just no sellers coming out. Here's another way to think about it, Raja. Here, once it dips down below A, there's a great opportunity for sellers to come in force, okay? If you think about it, as it fell here, coming down here, look at all the supply that came down, right, that came in. Look at the spread here, or the range is wide, lots of activity. The close is poor. It's all to the downside, okay? So we would expect that here as well if supply was still in control, but it's not. Why? Because we see that the activity is narrow and then it springs back up. And that's a way of testing for supply to see if it's exhausted down there, which it is. Okay? That should be pretty clear. Let me know if it's not. Does a close below the support line negate the spring on the retest? Not necessarily, Scott. I will show you in some detail as we go along how to read the bars for supply and demand as we go along here. And so sometimes it will, and I'll show you a couple of examples probably a little bit later on how that occurs, okay? All right, so let's go on now. So that's the classic spring. And here we were talking about when there's moderate volume. Notice that we're in a trading range here. We dip down at A and we get some volume coming out, right? But it rallies up and we come back down here at B and still fairly high volume, but we rally up. Now note, Scott, here was a question. Does a close below support line negate the spring? And here's a test, okay? And that's on this volume. So I wouldn't be concerned about this because here again, sellers have an opportunity to come out, but they don't do it. And only light volume is seen on that test, and a narrow spread as well, as opposed to look at the spreads on this coming down, and then look at the spread on this, right? It bobs back up. We get another test in here, this time above the support line. Is this better? Sure, of course it is. It gives you a better indication, okay? And the volume is even lighter than on the first spring bar that we looked at, or I'm sorry, the first test bar that we looked at. And it rallies up. But again, in the classic sense, this is a little bit too much volume perhaps on this spring, or the classic folks would say that it was. And so it comes back down again into, let me erase this so you see this clearly. We come back down into the same level as the spring bar where we had relatively higher volume. And look at the volume on C. Hardly anything. And then it springs back up again, or pops back up again. It's not a spring, and then rallies up. They even test it one more time. I mean, you'll see this a lot. And it's sometimes it can be a little nerve-wracking to see all this testing going on. Because testing occurs on either dips down or on down bars. Dips down like at C, or on down bars on a bar just like the bar after C. Here's another test right here. It dips down, doesn't draw out volume, and the market responds. So when you're looking at these, when you're looking at springs and tests of springs, you want to see the market respond pretty quickly right after that. If it doesn't, and we'll talk about this as one of the ways that a spring can fail, if it doesn't respond within a couple of bars and it kind of hugs along the lows here, kind of hugs this support line, then we have potential trouble on the horizon. But a spring will usually tell you in advance when it will fail. And that's another nice feature of this. As I say, this is one of my favorite trades here. Are all three bars below here called a test? Raja asked. Well, the test bars that occur here are going to be this bar here. We have a spring bar at B. The next bar that I just highlighted is a test because it's a down bar on low volume. Not a great test, but a test nevertheless. We see another test on C on light volume, another test bar here on light volume, and then a test bar up here on very light volume. So those are the tests that occur in this market. Okay. Okay, so let's go on. Let's talk a little bit. Let's go a little bit beyond the classic. And Raja asked a good question. Is the spring not a test bar? Yes, it is. In a way, it is a test bar. It dips underneath and then pops back up. Usually when we look for tests, though, we're looking for very light volume. As a rule of thumb, we say volume less than the previous two, although that rule of thumb is not ironclad. We can often see tests on, if volume is high in that area, even if it's on less than the previous two volumes, it doesn't necessarily mean it's a test. And even when we have light volume, but it's higher, it's not less than the previous two, it still can be a test. I know it's confusing, but it takes time to understand this stuff and to learn it. You have to spend time with the charts. Okay, there's one other question here about why is C not a spring? Well, it's not a spring. It might be a spring on a smaller time frame. This is ConocoPhillips on a daily chart. It's not a spring because it doesn't dip down below a support level. Okay, it's only coming here. The next level of support is at B, and it doesn't come down below B. Now, on an intraday basis, it is springing off of maybe, if we were looking at an hourly or maybe a half-hour chart, we would see a spring here, okay? So you can do that kind of trick too. You can look at multiple time frames, which we'll talk about a little bit as we go along. Frank asked a good question. When do we decide to draw the line from A to B? I'm drawing them all the time. I'm drawing lines all the time from A to B. And if it went lower, I draw another line there, okay? Does the spring bar set the baseline for a future test? That's how I think about it. Yeah, Gary, that's a good example. That's a good observation. It can. It doesn't have to all the time, but it certainly can. If you see a market come down and test in here, and we know it's testing because it's dipping down into an area. Here, look. Here's another way to look at this volume. This is the volume on C. As it comes back down into this area of B and also below, again, A, you can see that the volume is maybe not quite half, but it's substantially less. And if we were watching this on an intraday, if we were watching this real time, I would guarantee you that we would see light volume coming down, and then as the market started to rally, you would see the volume begin to expand. So throughout the day, this would expand, and so we're seeing buying coming in. That's part of the reason why this is a test. Excuse me, why this is a test. So B is the spring bar. Yes, B is the spring bar. C is the test. Would A be considered a spring of the consolidation range? I wouldn't consider it that way because of the way it came down. It's pretty high. You know, there's pretty much a lot of supply is coming in. You can see that supply is coming into the downside, right? Volume is coming into the downside. Just because it dips down doesn't mean that it's going to be a spring. We don't want to necessarily see that kind of action. Also, notice that both of these bars are closing on their lows. We're not seeing much of a spring action where it dips underneath and closes back up. We also don't close until 2 bars later back up, and we don't really close until 3 bars later. I wouldn't consider this a spring. It just doesn't have the right look to it for all of those reasons, supply coming in and stuff. David, we'll get to that question. What are the entries and the exits? Would I buy the test after the spring bar? I'd probably buy the spring bar and put my stop down below here. I'm pretty aggressive when it comes to these trades. I'd be a little concerned as it was coming down, but I'd be noticing that there's not much supply here, and I'd hold nice. I'd hold fast. And if I saw this, I might even add to the position. Okay. All right. So even in a downtrend, yeah, even in a downtrend, because truthfully, this is in a uptrend, and we've gone on here for a long trading range, and then we've come down and we've sprung it. If this is dropping out of a trading range, HF, this thing should go. I mean, you wouldn't expect, okay, it might rally back up. It should come down lower, right? Then come back up and test this, and then we would see yet lower prices, right? What's the definition of a downtrend? Lower lows and lower highs, right? But what do we see? We see it hold near the low, it rallies back up and goes deeper into the trading range. We do come back down again, but then we get a spring here. So there was some buying for sure going on here, and there's certainly buying going on here. And then it gets tested. So, okay. Let me move on here. So that's kind of a classic spring. So let's go beyond the classic now. Background, I think, is more important than a light volume retest. And we'll see why that is as the evening unfolds here. I've got 50 slides to go through tonight. We're going to see a lot of springs and talk about a lot of different ways springs evolve. Okay, but what we want to see here, kind of some ideal, to begin to frame an ideal type of trade setup. And I'm going to amplify this as we get into the additional examples. But just to get a basic, I'm going to kind of give you some basic concepts first, and then I'll show you nuances. Okay. One of the basic things that we want to do if we're not looking for a large accumulation, the culmination of a large accumulation range, is we want to see a good trend going up. Okay. Wyckoff called the trend, he said the trend was always the most important thing to know. It's the path of least resistance for price. And we can see it. Now, how do you all define a trend? Let me just get a sense of how you all define a trend to make sure we're all on the same page. We're all singing from the same sheet of music here. Direction. Okay, well, it's going to be more than direction. Good, DJ. Higher highs and higher lows. That's certainly an important way. Yep, Randy, good. Oh, good to see you, Randy, here. And Thomas. Higher highs and higher lows. Yeah, exactly. We want to see higher highs and higher lows. We also want to see, so higher highs and higher lows, right? We also want to see, sorry, I look like a kid doing this because I'm trying to do it with my mouse. As we're rallying up, making those higher lows, we want to see volume come in to the upside. Yes, good, Scott. Volume comes in on upsurges, increasing volume. As it reacts and puts in that higher low, we want to see volume recede, okay? And then as it continues up, we want to see volume expand again, all right? The other thing we want to see is wider spreads on the up move, narrower spreads or ranges on the down move. This is classic Wyckoff trending characteristics. Higher highs, higher lows, wider spreads, increasing volume on the upside, narrower spreads, decreasing volume on the downside. We don't always get it picture perfect, but that's what we're generally looking for, okay? In the background, so we're looking for strong trends. We're also looking for no significant indications of weakness. I'll show you a few examples of those on failed springs and why they fail, okay? We also want to see, especially if we're looking at higher volume springs, which I would encourage you to do, we want to see obvious buying at the support level, and I'll show you how to read that, We can see good trades, spring trades coming in on an established trading range, right? There are very good trades there, and I'll show you a couple of examples of that tonight. And as I said, we can also see heavy volume and no downside follow-through at the spring. Okay, it can be a good spring indication. So we don't need the light volume, but you need to be able to read the market, and you have to have some of these background indications there as context to be able to take that. Okay, but the key thing here is, I think, strong. These are all key, but strong trend and certainly no significant indication of weakness in the background. I don't want to see, for example, heavy volume and wide spreads coming in as we're coming down or at the top, especially at the top of the last swing high. And I'll show you some examples of that, okay? Everybody with me so far here? Okay, good, good. All right. Here we are now on the 5-minute S&P E-mini chart. Okay, this is not too long ago. This is sometime in April, earlier this month. So what do we have going on here? Well, we have an uptrend, right? We're making higher highs, higher lows, higher high at one. Look at what happens here. We get a shakeout, right? Big volume comes in, and notice the close and the next bars rally up. Hard to trade that. I remember this day. I'm looking at this and thinking that the market might try to go down, but then as it held in here, I realized it was going to go up. We get a bit of a rally, and this again is a higher high here, right? And still a higher low at 2. Then we come down, and notice how we're coming down. Not much supply, not anything like what we saw over here, right, on this shakeout. And this was, by the way, this was some news, I think, that came out. I forget what it was, what the news was. There was some kind of news. Maybe it was a stock earning, a primary stock that didn't meet its earnings or something, and it kind of pushed the market down. It wasn't Goldman Sachs. I'll show you that later. So we see high volume come in at A, and notice the close here. I forget, is that, yeah, I think it's closing here, and then the next bar is up. There's some buying coming in here on the high volume. If this was all selling, we would expect this to drop, but it comes in at the end of this little weak reaction. We rally up, and then we spring. And notice the spring is not on weak, it's on a little bit lighter volume than at A, but still on pretty decent volume, right? It pops right up nicely. Look at the volume come in as we rally up. We get some testing here. Notice the low volume. Some testing here. Again, pretty low volume. I think it's this bar here. And we rally on up nicely. It was a very nice afternoon rally that occurred. Okay? So here's a nice example of a spring that doesn't go low volume. We don't see low volume here. And we see some, craziness in the background, and then they come back in, and in a way they're testing this whole area, coming right back down here and making sure that this area is not going to draw out supply, and they do it in the form of a spring. And I'm using test here not as a formal test, but just in general. They're coming back into the same area where supply existed. And we know there was supply because of the high volume. Even though buyers overcame the supply here, there still was supply, and they're bringing it back into this area. The market is bringing this back into this area to check to see if there's more supply. Why? Because if it didn't and they started to rally it up and this supply was still present, it would come in and begin to crimp the buying that would be attempted to go on here. So finding no supply, there's a better chance that this thing is going to rally, and that's what it does. Okay? Lower volume at lunchtime. George, there's most days in the S&P does have lower volume at lunchtime. That's right. And many times you'll see a rally start between 1:30 and 2 o'clock on the S&Ps. If it's going to trend in the afternoon, that's a good time for it to begin to trend. And this is just a nice mark of that beginning trend. There are also times, though, George and others, that you'll see volume, high volume, and even trending conditions occur on over the lunch hour. Sometimes traders don't break for lunch. Most days they do, but sometimes they don't. Okay. Here's another example where background conditions are important. This is a S&P E-mini chart on a 20-minute time frame, where we come down and we have high volume come in. Well, first of all, we're in an uptrend. We're making higher highs, higher lows, all the way up. Notice the nice buying that's coming in through here on the wider spreads. And then as we react, we're getting narrower spreads here. And this is the open of the next day. And volume comes in as we push up. As we come back, notice how volume is receding. So we're in a pretty good uptrend here. It changes direction on us here, and we get a little supply come in. Some more weakness occurs, and then we dip down to A. And this is kind of like a little shakeout that occurs, as I would read this. We don't know that at the time necessarily, but we are the very next day coming in, we get 2 bars here on high volume, and notice on fairly high volume, bar 2, there's less. Notice that there is no further progress to the downside, and on the next bar after 2, we spring back up and close back up above yesterday's low at A. This is often, and I'll show you some more examples of this for those of you who trade the S&P E-mini. This is a very nice kind of trade. We see this a lot, and using yesterday's low for the support level and then springing off of it is very nice. And then at 3, we get a nice test here. Okay, a very nice test. So this is a little bit higher time frame, and if you're looking, than a 5-minute chart, if you're trading off of the 5-minute chart on the S&Ps, you see this, then you look for an opportunity to go in long on a 5-minute pullback here. And look at this, sets the whole day into a trend day up, and a very nice trend day up. Actually, next 2 days, I should say. This day gets a trend day up, and the following day gets we see continued follow through. Okay. Yeah, close the gap from the previous day. Gaps are not important with springs, so don't worry about those. Don't try to read too much into those with gaps. But here's another. Here's another nice spring with heavy volume. Okay, this occurs. This is another good example from ConocoPhillips, a good stock to watch for springs, by the way. Again, we're in a nice uptrend. We're making higher highs, higher lows. You can see that wider spreads come into the upside, right? We get a few down bars that are, negative and wider spreads, but look, most of them are to the upside, aren't they, right? So now we get some weakness come in, but the context of this market is strong. So we have a little bit of weakness. Now, look at what happens here as we turn around and look to spring this. Look at all the volume. Look at that. We get a down bar with big volume at 1, bar number 2, another big volume bar, but the market doesn't go anywhere. Even higher volume than either 1 or 2 on bar 3, and it's a spring. It springs right there. What that says is that this market was being bought. It was coming down here on a reaction, right? And it comes to this level, and somebody was in there buying, and they were not going to let it go down lower. And so when the high volume comes in like this, boy, you know, it's just, I mean, this is, you know, this is almost like a gimme. You want to take this trade. You really do want to take this trade. And then look at the rally that occurs from there, and it's still rallying from that point. Okay? So high volume on a spring does not kill a spring. In many instances, it will make it a even better trade. Okay? All right. Now, here's another good stock to watch for springs. This thing springs them all the time. APA, Apache Corporation. It's an energy stock. You can see we had made some sort of a low here. This was just a reaction this past year. It rallies up. We make the higher highs at one and higher low here, and another higher high and another higher high. And notice we have this, again, high volume here on B, right? And it doesn't go anywhere. It doesn't go down. It has to be buying. It's, you know, it's, Wyckoff used to call this bag holding, where in his day, and the postman, as it were at the time, it wasn't a post person, but there were mostly men. Maybe there were women, so we'll say post person. The post person would go out and have a big leather satchel or bag that he or she would carry all their letters in. And so Wyckoff called this kind of movement, what we see on this chart here at B, on this B here, and on the previous chart, it's like they open up the postal bag and they say, dump all of your stock, dump all your letters, or dump all of your stock into the bag. I'll take it. Okay? So price doesn't go anywhere. It doesn't go down anywhere. And the volume is high. It's just bag holding. They're holding the bag for the sellers who think that the market's going to go down and they want to exit out of this as soon as they can. And so we rally up. Okay? And we get another nice one here as well. Look at this. A little bit later, we make a support. Look at the buying that's coming in here. That's all buying there, right? It rallies up nicely. We come back in, kind of a lackluster, weak reaction down. We get some high volume at 1. Again, at 2, even more volume. And notice how the spread has narrowed here, right? It's another indication. We said that earlier that spreads mean activity. Widespread means lots of activity. Well, when spread narrows like this bar, like this spread on bar number 2, and again, spread is the difference between the high and the low of the bar, okay? When the spread narrows and the volume is high, and here it's even more than on bar number 1, then somebody is holding the bag for the market. Somebody is saying, opening that postman's bag, postwoman's bag, and saying, dump your stock in. In other words, every time somebody's selling, every time somebody's trying to sell stock, a share of stock, somebody's there buying it at that level. They're holding the bag open, so to speak, right? And look at 3. Sustained volume at 3. Even narrower spread than at 2. And then we get the spring bar, and it's a perfect spot to take a trade. Look at how the danger point here is like just a point or two, right? Very minimal. And this trade went on to rally up over 15 points, okay? George says, is that where Joe Granville got bag holders? Well, Wyckoff was the one. Many things come from Wyckoff. Support and resistance is a Wyckoff term. Accumulation and distribution are Wyckoff terms. Buying climaxes, selling climaxes, bag holding, all of that is all Wyckoff. He was one of the very early fellows to be writing about the market, and just, you know, that's the Wyckoff is the king. Well, Wyckoff is a very nice human. Yeah, he was concerned that that the public would just see, he was a broker, and he was deep, deep, deep into the markets. He would talk with other brokers every day and find out what Jesse Livermore and Harriman and the Sun Oil folks and Gould, all the big traders of his day, and there were fewer then, and everybody knew who they were. All the brokers knew who they were. And they would talk, and Wyckoff would begin to piece things together. He'd learn from 2 or 3 other brokers that maybe they were talking about Livermore. Livermore was selling, right? Well, he was selling, 1,000 shares today, and those 2 brokers would say. But in Wyckoff's shop, he was buying 5,000 shares, right? Or he had just bought 5,000 shares. So Wyckoff began to piece this information together and look at and be able to read what he knew from as like an insider to the market, to the overall market through his network of brokers and his own brokerage firm. He would begin to see, understand what was going on, and then he could piece it together with how the charts looked, and then he wanted to convey that to the public, and that's what we're looking at here, okay? Hey, Eric, how are you? You're liking this. Good. I'm glad you are. I hope everybody is. Have you been able to use Trade Guider to scan for these? No, I haven't. And I don't try to scan. I'll tell you a little bit about how I do this a little bit later. I have a handful of stocks that I look at, and I'll give you some ideas of other stock lists you can use to look for these things. And I just go through them several times, couple, 3 times a week. I'll go through my stock list, which are about, maybe 150 different stocks that I look at. So I don't do them all the time. I don't do them every day. That's too much work. But I do them a couple of times a week. And I'll just keep notes, and it's a good way to keep on top of the market as well. All right, so now every dip is not a spring, or not every dip is a spring, okay? I want you to be clear on this. Sometimes when I teach an 8-week course on how to read the market just by volume and price bars. And sometimes and I teach individual folks too. I do a lot of one-on-one coaching with people. And they'll send me a chart, like something like this. This was one that was sent not too long ago, and they say, this is a spring. Look at this spring. Or they'll ask, is this a spring? Well, no, this is not a spring. And this is not a spring because there's no support level. This is not support. This may be a good trade, but it's not a spring, okay? Likewise here, this is not support, okay? And so again, this may be a good trade, and in fact it is a good trade. It's a reversal bar here. It's a nice trade when you've got something like this going on, but it's not a spring. I will say that if we drop down, this is a daily chart of SPY here that I'm using. The SPY is the ETF for the S&P 500, and it's a good surrogate for the market. I like it because I like the volume characteristics on SPY. Here you would see this, you do have some support on this bar, the low of this bar, and on an intraday basis, this would be a spring. So maybe on a 15-minute or a 30-minute chart or a 5-minute chart, this would be probably a very nice intraday spring, okay? Likewise, this is also not a spring. Gaps don't count in this trade setup. They need to be, you need to have clean support, okay? Why do I say it's not support? Because it's not coming down and making a support level. It's just a bar. It's just the low of a day. That's all it is. In fact, there's not a support level here. There are support levels. There are daily support levels, but it's rising supports, okay? It's not a clean support. Is 150 a support level? 150. No, not really. If this market, this is not enough for me either. I like to see the market to come down a little bit, hit a low, come back up, and then come back down and test, and then spring under that support. That's what I like to see. About the 130 area. No, there's no supports here. There's no supports. You'll see more as we go along. Let me show you. Again, some people might view these as springs. I wouldn't. This is not enough of a support level right here. But it does come down and it dips below and pops off of it. So if you want to be loose in your definition, you can do that. It might be a good trade, but it's not necessarily a spring, at least the way that I conceive of a spring. Likewise here, we're in a sideways trading range. We do dip down below, no question about it, and we pop up and it rallies. But in my mind, this is not a good criteria for spring, okay? Go back and review the conceptual map of the spring and look and see that we establish support, we rally up above, we rally up, we come back down, and we retest that support level. Is 136 a spring? I gather you, I think you're asking, is this a spring? Yeah, I would consider this a spring. Yeah, I would. But I'm trying to show you what's not a spring here. This is one that I definitely want to see. No, this is a good spring. This is a good spring, and it gets tested here. Very nice test on this bar here, and this is good volume off the bottom too. I would like this, and if I was concerned for some reason about this and I saw this, then I would, this is not a spring, but it is nice testing that's going on, and I'd be apt to enter in here for sure. What if it doesn't dip below support? Okay, then Daryl, thanks for rephrasing that question. Then it's just a test. And it's just a regular old test. It's not a spring. How do I define sufficient as support? It's kind of by eye, Eric. It's making sure that there was a low that's put in, and then the market rallies off of that low, and then comes back down, revisits that low, and springs it. Okay. I don't think too much about volume climaxes. If I see that, surely I'll be interested, but I don't, I'm trying to show you more sophisticated, I guess, ways of thinking about springs so that you can take them in uptrends and that sort of thing as well. All right. Now, you've got a basic idea of the general concepts of a spring, and believe me, by the time we're done here, we will you'll have a really good understanding of them, because I'm going to go through chart after chart after chart. You'll probably want to stop me at some point, but you've got a general idea at least. When do they fail? This is as important as knowing when they're good. You want to be very careful about your trading, as I gave you in that, the disclaimer up front. It is risky, and you want to know how to handle this stuff if you're going to trade. When do they fail? Okay. Even in the best of circumstances, there's still a probability. And if there's a probability that they'll go up, then there's also a probability that they'll go down. And a probability is partly based on the setup, but it's also based on your ability to read the market and your ability to trade the setup as well. So I can't tell you that, gee, I get 79% of my trades, my spring trades are winners. That'll have no meaning for you. But they are odds. Every trade you take has an odds of working and therefore an odds or a probability of failing. When they have the biggest odds of failing, right here, when you're in a downtrend. Now, sometimes I'll take springs that are in a downtrend, and I'll show you a couple of examples of where you can violate this. But generally, until you get good at this, don't take them in a downtrend. They are very apt to fail, okay? Significant weakness in the background, particularly off of the last rally or swing high. And I'll show you some examples. We're going to look at some examples of this, okay? And then in any spring, even in an uptrend, if it's unable to rally away from the danger point, it's telling you that it's not going to spring. So you can be in a spring and everything looks good, but if it's not able to rally away from the danger point, the market action then is telling you that it's not going to spring. It's not going to be a spring. I mean, it's sprung, but it's not going to continue to spring. And it's a nice thing about springs. They'll often tell you when they're not going to work, and they're going to give you a chance to get out as a scratch trade or on a very small, modest loss, okay? So those are the 3 times when springs are most likely to fail. But remember, even when they are good, there's still 20, 30% chance that they're not going to work out, okay? And yeah, Rama makes a good point. Probability is operator dependent. In other words, it's trader dependent. You know, you can't just say. It's kind of a funny thing when we talk about this. This is a strictly judgmental system, right? You can look at a model driven where it's totally driven on stats, and then you can say, yes, if we take and do exactly as the model says, then we ought to come close to that the probabilities that exist for those trades. But when we're talking about a judgmental system, which this is, we're talking about the ability to read the price bars and the volume in the market and understand what's going on. Then your ability to do that is going to influence those statistics a real lot. And you should be keeping stats on yourself on every trade on every trade type you make. So if you adopt the spring, or you already have the spring in part of your arsenal of trading into your quiver, so to speak, one of your arrows in your trading quiver. If that's the case, then you want to definitely keep statistics on them for a whole host of reasons, which I won't go into. But here's our good old friend Goldman Sachs, and here's some good examples of when springs fail, okay? Notice that we're making lower highs, lower lows, lower highs, lower lows, and we see a spring set up. Okay, we see a spring set up right here, and this is just testing. Here was a good question that Scott asked. What if or Daryl asked, I forget which, where it just comes in and meets the low. That's just a test. It's not a spring. Here, however, it dips underneath and then closes back up above. So it springs, but look at what happens to it. It immediately sinks down, okay? And it's because we're in a downtrend. We're in that downtrend. They just aren't good in a downtrend. Here, look at this. This is a spring, right? But look at the weakness that comes in. This is the highest volume on this chart. My gosh, for months and months on this chart, right? Huge volume coming into the downside. That's weakness. And we're breaking out and breaking down through, Scott says, falling through the ice. This is a term of Wyckoff, actually of Bob Evans, of falling through the ice. Your support level would be your ice level. That's what he used to call it, because he used to create stories for traders so that they would be able to better remember the principles involved. So it's falling through the ice, it comes back up, falls through support. Now support is resistance, it can't get back up above it. It comes down, it looks like a spring, doesn't it? Looks like a nice spring. It dips down and closes back up. No good. It's in a downtrend and this thing just fails, okay? Here's another example of when a spring fails. I put a big red arrow there. Look at the weakness coming in here, okay? And yes, we get a little spring down here, but look at this. I would never think that this market would want to rally after that, okay? Even though the volume is lower here, this is just this has done a lot of damage to the market. This is, I don't know what stock this is, AM on a daily basis. It's a New York Stock Exchange stock. Just let this thing go. This is not a good spring to be taking because of the weakness that exists in the background. Up to this point, this market was doing pretty well. It must have been some kind of news that hit this thing. But look, we're going in an uptrend here, and it's not a bad uptrend. You know, we got good spreads to the upside, volumes coming into the upside. It gets a little bit, you know, dicey up here where there's not a lot of volume, but we don't see a tremendous amount of supply come in until here. But this kills the market for me. And it's just, you know, you don't want to be playing in this kind of market. There's thousands of stocks. There's thousands of good things to look for. You don't want to be taking trades like this when there's so much supply in the market. Okay? Here's another more subtle example of a failed spring. But look at this. We're in an uptrend of, well, we're in some kind of a move up anyway, and we pop up above this resistance back over here. But look at what happens. We try to rally up, and this thing in one day wipes out this buying that occurred over the previous couple of days, and then on the next day wipes out the buying on however many bars this is. You guys can count them up. I don't know, but it's a few weeks here anyway. And then it tries to rally the next bar, and the next bar comes crashing back down. And if you look, the big volume is coming into the downside here. And it's, you know, it's large volume. We're coming down, and volume is increasing. I don't like this. This is supply. This is not a good thing. Even though we don't have yet quite higher highs and or lower highs and lower lows, we got a lower high here. We don't really get a lower low until the spring. But this is just not a good setup to be taking with all of this supply here. More subtle, requires a more advanced understanding of chart reading, but that's there for you to learn. Yeah, Gary says a change of behavior. Exactly. A nice change of behavior. You're going up very nicely here, and it gets a little parabolic, a little bit maybe climactic in here. Although if it just, you know, reacted nicely, it would have, you'd expect this to continue to go higher. But instead what it does is it crashes down. The other thing it does too that shows weakness is it goes down below the support level, you know, and goes deep down below the support. So all this buying in here taken out on a couple of days is just screaming weakness out at us. You should be looking for shorts here, not long positions. All right. Here's one more example of a few springs here that fail. We see springs all the time, just like up thrusts in uptrends, and I caution people all the time about that. Springs and downtrends, the same thing. Here, spring number one, which is right here, looks okay, actually. I don't know what's going on. This is IBM on a daily. I'm assuming that there's some sort of an uptrend here, and it doesn't look like we're making lower lows. It doesn't look like we're in a downtrend, okay? This is an example where we have an inability to rally away from the danger point. We spring here, right? We get what might be an okay spring, and then we can't get away from it, and we start to go down. It's hugging the lows. That's a way to think about it. Hugging. You know, it's like embracing the lows. And what we don't want to do, this is a killer for a spring, okay? And this is one of the three things that we see. And even if the spring is really good, if you see this start to not be able to rally after a few bars here, it's usually not a good sign. And then we have another spring here, but now we're starting to see a downtrend condition start to happen. But notice again, we're still unable to rally away from the danger point. And it's given you clear indication of this, okay? So even if you got in, you've got good opportunity to get out with just a small loss. You can get out before your stop gets hit. And I would encourage that if you start to see it do this. get out, take the loss, look for a better trade. By this point down here at spring number 3, we're in a downtrend. And here, yeah, we got a spring. And notice how the volume is less. But boy, when they're in a downtrend, they're just generally not good. I'll show you a couple of examples where you can take them in downtrends. They're a little more risky, and so the odds aren't as good, but I'll show you a couple of examples where you can do it. Okay. Song says, do you always see positive divergence on a spring? Actually, no. You can, and I don't use any indicators to speak of, Song, so I don't really think about divergence or anything like that. And you'll see divergences all the time in a trend, and they'll be telling you to go the opposite way. But you know, you can pair that if you want to do that. I would say study that for yourself and see how that looks. But you know, if you're really familiar with an indicator, then you can maybe incorporate that into this and make it part of your trade plan criteria. Here again, not a valid spring. Once again, look at this. Look at this volume coming in. My gosh, it's just unbelievable. And yeah, we get a close off of the low, but this is the biggest volume on the chart in months again. So this is not a spring to be taken. And you can see that, yes, it does rally up a little bit and goes a couple of points. This is Holix, H-O-L-X, a good spring chart, a good spring stock, by the way. But, you know, it starts to come back down. And so if you got long in here, you'd see that this is just chopping away and there's no real strong rally going on here. And you'd want to get out of this. But don't take this because this is all supply. Will Wyckoff work in futures? Oh, yeah, Scott. I use it in the S&Ps all the time. You can use it in, you know, cotton and cocoa, all of that stuff. All the futures. It's very nice work. The springs are very nice with futures. All markets. All markets. Okay, entry considerations. Well, we've talked about tests and we've talked about spring bars. So you can enter right on the spring, or you can wait for a test of the spring and enter on a test. And it's kind of your choice. You can be a little more conservative and enter on a test. I tend to, especially on a 5-minute chart in the S&P E-minis, I tend to go right in on the spring because the market will, you know, let's just talk about this for a second. The negative of entering on the spring is that the market can come back down on you and you might be under a little bit of pressure, okay? Or it can hug the lows and you need to get out. So that's the downside of entering on the spring bar itself. The upside is that if the market takes off, like many springs do, then you are in and you don't have to worry about the entry. The test, on the other hand, you have a good confirmation now that the spring should hold, and then, and that's the upside. So you're getting in at a more confirmed level. But the downside is that you may miss the spring because it may just take off on you. Okay, so it's a judgment you have to make. It's your own, and you need to make your own judgment about this. And you know, test is clearly the safer, but you don't always get a test. Okay. All right. Exit conditions. Again, this is going to be your judgment. You can trail a stop on this. You can look for higher time frame resistance and exit there. You can scale out, part at a resistance level perhaps, and trail the rest. That's not a bad idea. Scaling out means that you would trade multiple contracts, or you know, let's say you traded 500 shares of a stock. Maybe you scale out, take profits off with 250 shares when you come into a resistance level, and then trail a stop on the rest and let a stop take you out. If you're trading, say, the S&P E-mini contracts, you would trade in, you know, preferably an even number of contracts, at least 2 contracts, and you would take one off at resistance and let the other run. And springs are not a bad idea to do scaling out. You can also have an indicator value, for example, a close above a moving average, for example, or maybe it's a moving average of highs, and you take you close out at that, or maybe it's an RSI value of, I'm making this up, but 80. Something you can do with this. You can use that as an exit consideration. This would be the least preferable, in my opinion. You could take a fixed profit of X number of points or X number of pips. It's kind of up to you. Springs can be pretty strong, as you'll see in some chart examples as we go along. So I wouldn't be doing the fixed profit, but that's me personally. I like to do the higher time frame resistance, and I like to scale out. So that's some things that you can consider, but those are some options for you. The other thing that you should always have in your exit strategy, whatever it is the ability to scratch the trade. If it doesn't rally away from the danger point, you want to get out. And don't worry about scratches. Even if it then turns around and goes, if you think it isn't going to go and you scratch out of it and it goes, that happens too. It's just part of trading. And it's scratches, good traders scratch trades all the time because things change, and they change quickly, especially if you're, well, in any market, but especially if you're trading intraday. All right, here is trade setup specs. This is a way to do it. You have the name here, the Wyckoff Spring. Your markets and time frames, well, the S&P E-mini on a 5 and 15-minute time frame, you'd be looking for them. Maybe equities on a daily and weekly basis, stocks, in other words, okay? And you can get even more refined on your equities by the universe of stocks that you might trade. You want to avoid springs, as we said, in downtrending conditions and when there's recent signs of weakness. I think I showed you some pretty good examples of that, okay? People don't usually show you examples of when not to take trades, but I want you to understand when not to take the trade. We want to look for favorable background conditions unless you're doing this just classically. This is, you want to look for good uptrending market, good strength in the market. We've talked about that in terms of spread and volume. You can do it in an established trading range. Good solid support, not those little dipped downs and not gaps, but good solid support. You might want to have good clear buying at that support. And you want to see no follow through to the downside on either light volume or heavy volume. You have to make the decision on this, by the way. You may decide, I don't want to do heavy volume trades, though I don't know why you wouldn't, but you might just want to do light volume springs if you do that, okay? And then price must reverse, okay? So the setup criteria is that price dips down below support and lower prices get rejected. That's the whole idea behind this. And then price rallies up and closes back up above the support level. That's your entry, okay? Or that's your setup, I should say. What did I do here? Price dips down. I just said this. I'm sorry, I repeated this. I made an error here. I apologize for that. That's just redundancy. We don't need redundancy here. So your entry criteria, now it's going to be your personal determination. Do you want to be more aggressive and enter on the spring bar itself? And you really should, or do you want to be more conservative and enter on the test? And maybe different springs will be different for you. Maybe some springs will have some criteria where you're going to enter aggressively and other criteria where you're going to want a test. Okay, that's up to you, but I'm trying to give you the framework. You need to do a little work on this, but I'm trying to give you the framework to set yourself up so you're in good position to trade these. Protection really needs to be placed below the low of the spring. And part of this is your maximum risk. And again, it's going to be a personal determination based on your account size and your risk tolerance. But you really don't want to be placing more than a certain percent of your current account size on any trade. But we're talking about springs. So in the magic numbers for this, I mean, there's different numbers, but some folks will not put any more than 1% of their account size. So if they've got a $100,000 account, they won't risk more than $1,000. Okay, doesn't mean that they put on a trade on of only 1,000. They might put a a trade on of 15,000 in shares of stock, but they won't risk more than 1% of their account, and maybe up to. So just all I'm trying to do is just suggest you in your trade setup criteria, make sure you know what your maximum risk is, and if you can't meet the criteria on your maximum risk, you do one of two things. You either reduce the size of your trade to meet this criteria, or you pass on the trade and you let it go. Okay. Profit target, we talked about those. Again, it's going to be a personal determination. Look at springs in the markets that you trade and see what makes sense for you. You can trade a stop, you can exit out on a sign of weakness, a resistance level, some fixed profit, or an indicator value. Okay. Funny thing, I didn't. Oh no, I did. Okay. And then there's trade management. You might want to scale out. You might want to trail that stop or move it up. In other words, as it continues to move. And you certainly want to exit out on a failure to rally. We talked about that. And there may be other criteria too. Like time stop. You may have if it doesn't give me a profit in X number of bars, which is basically time, then you might want to take the trade off. Paul asks, can support be a trigger number or some other line on a chart, such as a previous day value, high area, or low? No, Paul, it can't. Good question. It's not about pivots. It's not about triggers. It's not about a market profile value area, high or low area. It's all about the support that exists there. Not to say, Paul, that taking a trade off of a value area high isn't a good idea. It may be a very nice trade or a trigger number or whatever. But it's not a spring. Okay, and Scott says, when I make enough money, I'm going to come back and take more classes from you. My classes aren't very expensive. This is cheap, and the main classes, I mean, you see that I give you an awful lot of, the value, I guess, is pretty good for the cost. Okay. Okay, now we're going to go into now we're going to start getting into charts. We've done a lot of talking on things, and now I want to get into charts here. And I want to just highlight a couple of things. They occur across all time frames. I mean, you see springs, monthly springs. You see them yearly springs. Somebody showed me one, annual spring off of an annual chart. It was amazing. But monthly springs on the look at a long-term chart of the Dow, and just you won't see volume, but look at the price bars on a monthly basis and look for springs. Trading ranges are great places. Use multiple time frames. I'll show you a couple of examples of that. This is a wonderful thing to do, very good thing to do. When you've got a higher time frame support and you get a spring on a smaller time frame, it's lovely. Certainly want to look for uptrending markets, and I'll show you some tricks about uptrending markets. Now, before I go on, I got some notes here. I want to make sure you get this, okay? In uptrending markets, it's a great way to enter a trend. You know, if you missed the bottom or you didn't see it, or, you know, you didn't want to take it down there, as the market's moving up and you'll see a spring or two occur, it's a perfect spot to get, well, I shouldn't say perfect, but it's a pretty nice spot to get long, okay? So it's a good way to get into a trending market. And really what the spring in an uptrend is just saying to you is that the market is likely to go higher. And I'll show you different ways and also different setups to do this. Okay, some good ones too. All right. Just to talk about time frames for a minute, here's a weekly chart of Goldman, and it's back in a while ago, but you can see a spring here on B, and it was tested on C, and lots of buying came in on both, and then that was the end of the accumulation. So the classic stuff is still there, and it works nicely on a weekly time frame. Look, The higher the time frame, the more you're going to get out of a spring. So it always pays to look at the higher time frames. And when you can spot one on an extended period of accumulation like this, look at this is a year and a half, more than a year and a half of accumulation. So, you know, it's going to have, Wyckoff used to talk about cause and effect. This is the cause here. It's building up a cause, and the effect you can see. And again, this is a weekly chart. Okay, here's a weekly spring in IM. Now, immediately you're going to be saying to me, isn't this in a downtrend? Isn't this supply all over the place? Yes, it is. However, I told you I would show you some ways to look differently at that. But again, we're on a weekly chart in IWM. For those of you who don't know, IWM is the ETF for the Russell 2000, the smaller cap stocks in the U.S. market. Okay, it's a good one to trade. Look at this. This is the same chart broken down into a daily view. Now, I'm going to show you some ways to enter into a spring in a downtrend. First of all, we get some buying coming in here at A, and we get more buying coming in at B. Okay, that's the first thing to note about this. We're getting some climactic action here at A, it looks like to me, and then we rally up and we test it. We rally up again, and the tests are pretty good rallies. Okay, but this downtrend has a certain line to it. And notice that we come down to C and we make a support, nice support level here, clear and defined. And by the way, let me just go back to the other thing about that, something else I wanted to say, like about pivot numbers and Fibonacci and all of that stuff. What I want to see in a support level, I don't use any of the Fibonacci or any of that stuff. Why? Because it's not obvious. I want every trader in the universe who's trading my market that I'm trading, I want them to see that support. I want them to know that it's there. Okay, I want it to be obvious and clear. The more obvious and clear it is, the better it's going to be if we get a spring off of it. Okay. Now, so I'm not dissing any of that other stuff. I don't use it. I am looking into. In any event, that's a side thing. Look, we're in a downtrend and we're coming down. Notice, though, this rally. What do you all, let me ask this question. What do you notice about this rally? What's significant about this rally? Why am I interested in this now as a spring? Can anybody say? Demand's coming in, but how do we know that? Yeah, Eric and Debbie, you got that. Right. It's longer than the previous rallies, right? Look, here's a good tip for you on noting when the market is changing from bearish to bullish or vice versa, but we're talking about bullish markets here. When the market starts to change, you're going to see a larger rally occur. And this is the biggest rally that we have in the downtrend, okay? For those of you who know me, know that I like to look at the wave structure. The market moves in waves. This is the longest and largest wave in the downtrend, okay? Another way to think about it is just that it's the biggest rally in the downtrend, okay? That's part one of this. That's a clue. And you will be able to see that certainly by a break of the downtrend channel, okay? We're seeing a downtrend channel break here. But the key thing is that we have the largest rally going on in the downtrend. That means that buying came in and they were able to sustain it for a longer period of time and drive it to higher prices. Now it comes back down, but notice this reaction down and compare it to this where we were plummeting and this where we were coming down pretty hard, right? These spreads or ranges are narrower than any of these back here, aren't they? And notice the volume. As we're coming down in here, gee, It's about half of what we are at C, and maybe a third of what we are at A. And when we, oh, maybe that's upside. So those are some keys to note that there's been a change of behavior in this market, and we're getting some confirmation of that change in behavior on the downside, right? And that's what makes this spring okay to take. All right? Does that make sense to everybody? I see that typo, Gary. Yeah, that's okay. Okay? This is how to look at these things. All right. Here's springs in a trading range. Here we are. We've been in an uptrend, and a nice uptrend. Here's another IWM, another nice stock for looking for springs. And notice we come down to the bottom of the trading range, and at bar 1 there's an increase in volume, and it kind of halts here. Bar 2, same thing, lesser volume. And then we dip down, and we come back up on bar 3, and then later on we spring. But look at the volume is receded here on bar 3, and then we come back up and go into the trading range, okay? A nice, if I saw this, I would dip down, I'd drop down, not dip down, I'd drop down to a smaller time frame and look for maybe on an hourly chart or a 30-minute chart for an entry, some sort of a reaction or a testing that would give me some sense that it's okay to go long. So now not everybody can do that if you're an end-of-day trader. So you'd have to, you'd be buying in, you would wait until the spring closes above here. So now you've got a large, risk, and you probably couldn't make that trade. And that's okay. You let that go. You just pass it because there's plenty of opportunities all over the place. Here's a spring. Now, looks like we're coming into a downtrend, and I didn't show the whole chart, but we're in a good uptrend here. So I know that this isn't, I know it looks bad, but it's not as bad as it looks. And plus, we've been going sideways for a while here. Now, we come in at 1, and we close off of the low. It still looks pretty negative, and you would expect the market to go down, but the very next bar pops right up. And not bad volume. I mean, the volume's pretty good there. Not as large, certainly, as 1, but, 1 is the largest volume on the chart except for A here, right? So the next bar here, 2, dips down again into this high volume area and then rallies hard all the way up and drives all the way up, okay? That's buying coming in. That can only be buying to do that, and it's strong buying coming in. Somebody's trying to change this direction. Now it comes back down, and we come down to 3, but look at the volume at 3. It's much lighter than we were at 1 and 2, and we dip underneath, and it springs. Okay. Now that would be an aggressive trade to take on this spring. However, at T, notice I put in this test bar here. A very nice location for this with all of this buying in the background. Okay, so this is another way to look at a downtrend, and you see clear evidence of buying going on, and rapid buying, not long prolonged buying, but rapid buying going on, meaning that they want this stock and they don't want it at, they want it at this price, whatever this price was, 53 or 54. And they spring it up, and then they test it after that, okay? How about a bio spring break after this chart? Okay, yeah, I've gone on for over 2 hours now. I said it was going to be 90 minutes. I apologize. A couple of questions here. On this chart in May, if you're not buying on the test, are you buying on bar number 3 or the next bar? You'd be buying on I would be buying on the test here where it's marked T. Okay. All right, we're going to move on then. I'm going to go a little quicker because I do have a lot of other charts here. Here's another good example. Here's an example of using a higher time frame support. Yesterday's low. This is the S&P E-mini market. On a 10-minute basis. So we make a low, and then the next day we make a low one day, the next day we come down and spring it. Now, we didn't get a terrific, it sprung it later in the day, we didn't get a terrific rally off of it, although it does rally overnight and it gaps up and continues up the next day. We put in another low this day, we come back down, spring it, and then rally up from there. Not great, these are not particularly grand examples of them, but they're good good examples of using a spring and using yesterday's the daily time frame low as a support level for the spring bar. Also note, I put a green arrow here. We have the largest rally here in this little downtrend that's coming in, signaling a change in behavior in this market. And then it does, in fact, change. We have several days of going up. Okay. Here's just some typical springs. This is in a low cap. I put these in just to show you that this you can, this is a small cap stock or a low capitalization stock. It comes in at $7 here. We're in an uptrend. We spring here, and look at what happens. Here we are at the $7 mark, and it goes and doubles in value. Sort of a typical good spring here. Again, springs and uptrends indicate that higher prices are likely. Here's a spring in a large cap, a couple $100 a share for this stock. Now notice we gap open here on a big gap. We've rallied up from, I don't know, the lows here are a little bit above 140. We've gone up $100 on this stock, 100 points, right? And now you're saying, geez, I don't think I can get into that. But look, here's an opportunity to get in. A lovely spring here. And look at what happens. We rally up, we spring again, and we rally up, and we go up, however many points. This goes to 60. This is $50 here. A nice run in the stock. We go from a $2, looks like 208 entry or so, up to above 260. Not a bad trade. Let's keep going here. So that's in a high price stock. Here's, again, you need to use judgment on this. Here's a spring, but you're saying probably this is a downtrend, isn't it? And it is. We're moving down, but we're also going up. We have a more significant uptrend going on. And let's take a look more carefully at this setup here. Notice that we are coming down here, and on our trend channel at the spring level, we are getting oversold in the trend channel. Okay, here's the spring here. I'll highlight it in blue, and you can see there's a trend channel coming down. We're oversold there. We also have support I drew in red here from back at this point, and we've had a large rally. We've at least broken the downtrend, all right? So there's been a change in behavior. So breaking the downtrend, being oversold, coming into support, and springing all at once, not a bad trade, okay? So don't just look at this stuff mechanically. Begin to understand that the judgments involved, and that these things can really be helpful in making, but you got to piece things together. You have to, kind of weave the elements there together. Now, here's a good question. Can this chaos really be a spring? This is RIM, Research in Motion, the makers of the BlackBerry, on a 15-minute chart. So if you're day trading stocks, here's something to look for. Look at the buying. I put arrows in here where there was good high volume in most cases, and look at the price bars. Every one of them dips down and rallies up, dips down, rallies up, dips down, rallies up, and we get a little rally after that. Notice here we dip down, it's a down bar. Look at the volume is low, right? This is a way to read what's going on in the trading range beforehand. Then we get the spring right here, okay? So there's buying going on all across this trading range. We get a spring, and here's the spring here. And by the way, this was in an uptrend. And here's that buying and buying and buying and low volume dip. And then we come down, spring it, and here's, you know, what it does. A nice move on a 15-minute chart. Okay? It looks impossible. And yes, there was shortening of the thrust, Erica. You got it right. And see, I get so excited about these things. I even use exclamation points. Yes, it can be. You can take chaos and make it into a spring. Okay? All right. Here's something. Here's a nice little secret that I'm going to show you a couple of examples. Once again, our friend APA, one of my favorite spring stocks. Look for this setup. This is probably, I won't say it's the very best, but it's getting there. It's probably one of the very best long trades that I can think of, that I can make. I really love this look. I love this when it occurs. We're in an uptrend. I couldn't fit it all on here because I wanted to show you the response of this spring. We're in an uptrend. We hit, you know, a point where there's some profit taking. We get a little reaction. This is support here, okay? Or this is resistance right here, right? It's resistance here. There was a little bit of resistance here. That turns into support. So, and it rallies up, goes through that resistance, and then comes back down, and it's testing in general this support, finding no supply. And when you can find a spring sitting on top of support, longer term support, ooh, is that a nice trade or what? Okay? Look, here's a couple of more. This is in the British pound. This is the currency, okay? The daily chart of the British pound. Look at this lovely support line coming across. We dip down here, we rally up, nice rally, we come down, nothing to write home about in terms of weakness here. There's not much weakness coming in. It looks bad, but look at all the volume here, and it springs, and it dips down, tests again. Somebody said, can you still have it dip underneath? Yes, you can. There's a bunch of testing going on in here. Anywhere in here is a good place to take a long. It rallies up, and then we get another spring again here. So it happens all the time in the currencies as well. I'm not a currency trader. I should do it, but I don't do it. But I'm telling you, this is one of my favorite looks right here, is a spring on top of support. Okay? Just to beat the horse dead, here's our good friend ConocoPhillips again on a daily basis. Another spring into support, and then it rallies up. I don't know, we're in the $76 or $7 level. It goes all the way up to 90. It gets a little parabolic here. It's climactic, and then it comes off, okay? Now, so that's one thing to look at and look for as a real choice spring setup. Now, you don't have to have that in all your springs, but it's pretty nice when that occurs, okay? Here's another one, a power buy. This is a Linda Ratchke idea. It comes from Elliott Wave. And now, I'm not an Elliott Wave kind of guy. I do pay attention to these things, though, because they are pretty powerful. Linda looks at an ABC complex Elliott reaction, Elliott wave reaction. Complex meaning instead of just a simple little reaction here or a simple little reaction here, this is more complex because it's up and down, okay? She calls them power buys. When you've got a nice uptrend going and you got a power buy, an A, B, C reaction, in general, they're pretty nice. Now notice this one took a couple of times, a couple of bars down here before it sprung, right? And that sometimes happens too. But look at this, it goes nicely. Now, here we are, we're coming to the edge of this chart, the right edge of this chart. We get high volume. Is this supply? Okay. Well, here we are here. look, in an uptrend, there's no significant weakness in here. And when we're in a good uptrend, this stuff is, you know, especially when it springs like this, it's just buying coming in. You don't want to get scared out of things like this. And look at what it does. I mean, gee whiz. And it, you know, this power buy gives people a chance to, you know, folks are thinking, oh, we've made a lower low and now we're going to make, or a lower high rather, or now we're going to make a lower low. They go short on this, and they do. And that's why you see all this volume come in. And then notice how as they dip it back down again, the volume dries up. They test it a couple of times and then it rallies because of all this volume. So, you know, and then the shorts are forced to cover and it just fuels the uptrend. Of course, this is a good uptrending chart anyway. This is, again, EWZ, the Brazil ETF, okay? I don't know. This is, yeah, we're not really talking about OOPS tonight. That's another Bob Evans trade. It's similar to this, but it's a little different. Here's the SPY, okay, on a daily chart. I don't know how many of you remember back here in July, but I remember this. This was the March. This was the lows of the bear market right here. We rally up, and everybody's saying, I doubt this rally, I doubt this rally. Here is a head and shoulders. I made a comment about this on my blog in advance of when this all occurred. I said, I don't think so. But there's the right shoulder and the left shoulder. And they said, you know, you can measure this and it's got to move down to here. And what do we get? We have an ABC power buy with a spring in SPY. And look at what happens. And then up here we get another power buy. This was in February. This was the last reaction. Okay? We get that nice power buy, the Elliott wave ABC correction. Everything else is simple ones, right? All of these are, well, that's an ABC here too, but not quite. And yeah, it is a spring. I should have highlighted that too. Sorry, I missed that. But this is nice. It's a wonderful trade. Okay. Yeah, no worry, Erica. No interruptions. I don't care. Here's some more examples just on a trading range. We talked about that as a good spot to look for. This is XLE, the energy stock. We have a spring here and we have a spring here. Again, we're in an uptrend. When we're trending hard like this, these things are just wonderful. Here's another recent example. Everybody should know what this is, or maybe you don't, but this is a 60-minute chart of the S&P E-mini. This is the futures chart, okay? Here's the Goldman Sachs event where they said, we're going to bring you to court and we charge you with alleged fraud for your role in subprime mortgage CDs and bonds and that sort of stuff, right? Okay. It drives down huge volume, you know, it scares the daylights out of everybody. And then the next day, look at what it does. It springs, and then it tests that spring on an hourly basis. And look at the rally we get out of it. And then notice this, too. We come back and look at the low here and look at where it goes, right to this heavy supply that came in where everybody bailed out of Goldman Sachs and all the financials got a hit. So it tested. Here's an example of a bigger term test because this was fairly significant. And then it rallies up to make new highs. Okay. Here's a live spring. I just took this off the charts. It's slightly more updated than what I sent you out this afternoon. This shows the close today, but I sent you out a little bit earlier version, roughly when I took it. But we're in a nice uptrend, and I think we have more room to go. You know, you don't know. This may fail. I don't know. But look we got high volume come in here, higher than what we had on the A part over here, right? But look at what happens on that volume. They close it up. They can't get it lower. So I'm anticipating that this thing will rally up. We'll see what happens. It's a good odds trade. Okay, so there's a live one. So you can track that and take a look. All right, so we've done a fair amount of talk tonight, fair amount of work. I said 90 minutes and it's now 2 hours and change here. We've gone through the basic elements of the spring. I've given you a nice conceptual map of the spring. We talked about how background conditions kind of trump the light volume and really are key to taking any kind of spring that's not in a long drawn-out accumulation range. We want to see that evidence of buying. We talked about what a good uptrend is all about and how to detect it. We talked about when springs will fail. We talked about downtrends being killers for springs. We talked about significant weakness coming in, particularly at the swing high, but also on the downside with that, tremendous volume and large spread, not a good thing. And we also talked about how when there's an inability to rally away from the danger point, that is just a cardinal rule to get out of the spring, okay? We also talked a little bit about when we can kind of overcome the downtrend, especially when we see that largest rally in the downtrend occur, or really, really significant buying that's really obvious, then we can look to take a spring, okay? We talked about different entry options, being more aggressive, being more conservative. We talked about a variety of different exit options, and again, those two things are going to be your judgment. I gave you some detailed setup criteria. You can detail it even more. You can have different types of springs if you want. You can do pretty much whatever you like. I mean, I've given you kind of a fire hose type of information here. I'm dumping out all that I know on springs, which is, when I look at this, it's a fair amount of information. It's going to take you some time to integrate this into your own trading. So go slow and really study this well, and go back and review this a few times, especially the additional tips and examples where I talk about how, some really, really choice setups on support. If it's, if you're day trading, look for them on the tests of yesterday's low. If you're looking for swings, look for the swing trades, look for support. Look for old resistance that's now turned into support. Look for power buys and springs. I mean, those are some good stuff, okay? Now I'm going to send out to you a little feedback form, and I would really appreciate it if you'd fill it in and I ask you to rate it and what did you like, but also where did this fall short? Where can I improve this? And let me know, and I'll send that out to you in an email. And I just want to close with the guy who taught me the most about springs, and that's David Weiss. I consider him to be my mentor. I spent a lot of time working with him. And he said that if you only traded springs, you could do quite well. And frankly, he's absolutely right about that. He's got a great concept here with his springs. He showed me a lot about the high volume springs and everything else. Well above, because he's spent 30 years studying this stuff. And he is one heck of a great guy, David is, and one heck of a good trader. So I want to thank you very much for coming in today and being a part of this. I hope you got something out of it. I try to give you everything I know about springs, and I hope you got something out of it. And please, I'm going to send out the I'm going to email out the feedback form, and I really would appreciate it if you would do that. So thank you again, and good trading, trade mindfully, and all the best to everybody here. Thanks a lot. Bye-bye now.